inflation, right? They're concerned that at some point we're going to wake up and there's going to be runaway inflation and the Fed needs to get in front of that. And then you have the people who are like, well, maybe we should just stick with what we're doing and just go status quo. So it's kind of a tough situation because, and the reason I'm getting into the detail on this is because it's one of the things I'm going to talk about as a potential trade for the week. So let me just say, I'm going to go off a little bit here on economics and Federal Reserve policy, but it's going to lead directly into a trade type for this week. So, which is the reason that I thought this poll question was good. And what we have is we have a very interesting situation. We have rates that are very low in what we in a good economy. So you would think that that's kind of a recipe for inflation, right? And then on the other hand, though, you have Americans, a lot of Americans that have a lot more debt than they ever used to have. And this is all pretty much started, it started, whatever, it may be in the 80s, but it really was amplified in the debt crisis that we had in, 2008, 2009, right? A lot of Americans never really fully got out of debt from that situation. Maybe they took care of their house situation, but everything else is still out there. So you have a ton of debt out there. And if we raise rates, it has the potential to spiral into a lot of bankruptcies. So the Fed is certainly aware of this, right? They have all this. They know what credit card data is, they have all that stuff out there. They know that the U.S. debt, the U.S. has to pay interest on its own debt. They know that that's already a big part of the budget, right? So they have that situation going. Then on the other hand, though, they have to be concerned about inflation in a growing economy. So you have these competing factors, and it's not necessarily an easy answer. Anybody who says, if you follow Twitter, you follow financial news, anybody who's like, oh, the Fed should do this, the Fed should do that, they have no idea what they're talking about.
Yeah, they're idiots. They're idiots, Jay.
They're idiots. No, it's complete BS. They have an extremely complex situation without an easy answer. So there is no right answer here.
Well, I think if we look at it, most people so far in the poll, about 3/4 are feeling that there's going to be no change, and the remainder are looking at lower rates. Nobody's thinking higher rates. Hey, I want to give a shout out. Stephanie was having a little trouble with her webinar. First of all, use Chrome. Chrome browser works better with these webinars for whatever reason. I don't know. But if you guys have any trouble where it hiccups or you get the echo or it freezes or whatever, just refresh your browser. That should take care of it. So there we go. Do I think they're going to raise rate? If it's possible to pull rates into negative territory, that's what I know Trump wants. So I don't know. I've been saying for months now on the show, I feel coming into this election cycle, Trump is just going to do everything on the planet to make the economy good. So I don't know. We'll see how it goes. But he's certainly going to pull every lever he can.
There's some great questions in here, so I'm gonna wrap up this part and get to some of these questions because there's some.
You want to dive right in? Nice. Why don't we start right away with Olga's question? I'll read it out so everybody who maybe can't read it. It says she wants to talk about UVXY. So the instrument is, she writes, the instrument is directly linked to volatility and seems like premium prices are fluctuating a lot depending on volatility. If you can share with us your knowledge, is there a way to trade volatility using UVXY options? Is that possible profitably? What do you got for us, man?
All right. Yeah, thank you for that question. Great question. And also, I will mention. Later on. I'll talk about with the whole interest rate thing. I will mention a trade. I didn't forget about that. But just there's some great questions here. I want to talk about this stuff, and then we can look at some trade ideas. But so UVXY.
Hey man, this is what it's all about. Like I really want to provide like this place where our premium members can come and ask correct questions directly. This is actually what I want to get into. This is awesome.
Sure. Yeah, it's on. There's some really great questions. So for those of you who don't know, UVXY is a 1.5 times levered long volatility instrument. So we have VXX, which is your standard long volatility it's technically an ETN, so it tracks the first two futures of the VIX. So it tracks the first and second month future. So it's short-term volatility, which most of the action in the volatility curve happens in the front months. So VXX is kind of the most popular instrument, but UVXY is traded quite a bit because it's got a little bit more juice to it. It's 1.5 times levered. It used to be 2 times levered before Volmageddon a year from last February, right? Mm-hmm. And they cut it down to 1.5, and but it still moves, a lot faster, as you would expect, 50% more than, roughly than what VXX moves. So what it is good for, and with the disclaimer saying that you have to have very strict risk management procedures in place, it is very good to sell options on. I like to use it as sort of a semi hedge almost to a I trade a lot of credit put spreads in one of my services. And so sometimes I like to sort of hedge that with put spreads in UVXY or VXX, in the sense that they, when they go up really fast because volatility tends to spike. But the momentum of those things is generally downwards because without getting into too much technical detail, you have the futures roll and basically in contango. And so every time a future month expires, it tends to drop down the futures curve, which tends to make UVXY and VXX lower. So if you look at a graph of them, it's going to be very much a downward picture with the occasional spike. But when you get down to low levels of volatility, the volatility is fairly compressed. So selling a put spread, if you sell it, far enough out of the money, it's not going to get there that quickly. Meanwhile, if you have a down day in the market, it spikes right back up and resets. So I find it as a good way to sort of have a hedge for my portfolio that also has a chance of earning some income. On the other side, if you just want to pure do a credit spread on it, you can sell call spreads on there. There is obviously the tail risk event there where the market falls off a cliff and your call spreads in the money, but 90% of the time, 95% of the time, if you're feeling confident that there's not going to be a volatility event, selling call spreads, I see a lot of professionals sell call spreads in there, but they do probably have, just again, disclaimer, professionals probably have their tail risk hedged some other way, right? So you might see them sell 20,000 UVXY call spreads, but they might have some futures or something somewhere else to protect against that. So they're probably not just selling those call spreads in a vacuum. But if you are careful with your risk management and you keep an eye on the VIX curve and things like that, UVXY can be a really good instrument to sell credit spreads in, because the options are juicy, because volatility can move a lot.
Right. That's a great answer, Olga. So not easy, but a good option there. Real says it's going lower by a quarter for the looks only, to appease the Twitter in chief. Love that. Love that one. Mike is asking, what options structures offer the biggest reward if you are correct in your volatility assessment? So, and then he goes on, what option structures are you most commonly using?
That's another great question. So as I mentioned before, I do like to use credit put spreads quite a bit. The reason I use more put spreads than call spreads is because puts are used to hedge. So there's generally more premium in there. If you look at a skew curve of an options, you'll see and this is all stuff you can find on Market Chameleon, but you'll find you'll find the put side is generally more tilted higher than the call side because people buy those puts for protection. Now, what I do though is that because I sell so many credit put spreads, is I also hedge the entire portfolio. I usually use like a debit vertical spread or a put butterfly in SPY or some index, so you have to keep in mind that when the market goes down, assets tend to correlate, right? Everything starts to go down at the same time. So if I'm going to be selling a bunch of credit spreads, I usually hedge my entire portfolio so that if everything goes down, I make some money on that hedge to offset what's likely happening in my credit put spreads. So sometimes and not lately. I like, if I feel pretty good about volatility, trading sideways or going lower, or it's gone high and I think it's going to come back down.
Right.
I used to use iron condors pretty religiously. Iron condors are a lot better in index products rather than single stock type products.
Yep.
And the issue with iron condors, the reason I've gone away from it is because they are really good in the index products, but the index products have been absolutely flooded by professional overwriting funds that literally spend billions of dollars every day selling iron condors for clients. And it has completely smashed the iron condor market in particularly in the SPX and the S&P 500 to the point where it's just not really worth it anymore.
Yeah.
Used to be a really good way to make money, not so much anymore. I mean, you have funds like Harvest and UBS. I mean, they literally do, 20 billion of these iron condors, and it's so, but I did like, so I'm talking about short volatility. So for shorter volatility situation, which is generally most of the time, iron condors, credit put spreads, longer volatility situations, straight up debit spreads are good. Just, your vertical spreads, particularly in index or volatility products. I like butterflies if you feel more confident in a range, like you think it's going to go to a certain range. I like butterflies because they're cheaper. So I don't, I like to use different stuff because things change. That's the thing about option trading, is that things change pretty regularly. Where, like I said, like iron condors used to work and now they're not working that well.
No, you got to have different tools, right? Depending
gotta
on
have
what
different things. Yeah. So I'm like, for instance, in my service where I sell credit put spreads, I'm going to introduce calendar spreads as a way to sort of take advantage, because in this market environment, calendar spreads, with, volatility kind of going down, but maybe some sort of back month issues popping up later in the year. I think calendar spreads could be a good way to trade this market. So, it's not like a one size fits all thing. I think
I mean, like everybody wants, like, hey, what's the one thing you use that you depend on, that you go to? And it just, nothing works that way, right? It's like the moment you get into it, well, guess what? Other people recognize it too. And then it becomes flooded, and then there's no margin in it, and then it's gone, right? I mean, that's just that's the way the world works. That's capitalism, baby.
Yes. Anytime there's any sort of edge, you can guarantee it's going to be arbitraged away by people with $1 billion, right?
Sooner or later, right? Absolutely. Good stuff. Will's asking, how do you look at Skew and when he may want to be long or short the Skew of an ETF? You know what Will's talking about there?
Yeah. I was finding the question. I'm more of a, what do you call it? Like a visual person than an auditory person.
Oh, you can't.
I like to
my beautiful reading voice doesn't do it for you.
Maybe if you read it like in one of those really calm voices.
Jay, how do you look at Skew and what? You're like, Skew? I don't even know what Skew is. Oh, that's what Skew is. Yeah.
Skew you, buddy. So, sorry, that was really bad. I apologize.
Hey, that's good stuff, man. It's all you can throw in. Please throw in a little humor, man. That's good stuff.
All right. So the deal with Skew is, I don't know if you're familiar with Ewan Sinclair. He wrote Volatility Trading, which is probably the best volatility trading book on the market. And actually, ironically, liked a picture of my cat yesterday on Twitter.
Dude, did that make your week or what? You were like, ding, ching. Was that on Twitter or the Instagram?
For some reason, on Twitter. For some reason, he follows me on Twitter. I have no idea why.
Awesome, man. Dude, I love
that. So he's a freaking volatility mastermind. And if you ever read his book, he talks about Skew, and this is what he says. And it really has really changed the way I looked at it. Cause as a market maker, I had to look at Skew all the time, because how we priced out of the money options, like pricing at the money options was pretty easy. Like that was, everyone pretty much agreed on the price of the at the money options. It's the out of the money options where the prices vary and depending on your opinion. And so skew really mattered as a market maker. So when I got into the other side of trading, being the guy, sending in the trades rather than being the one, responding to them, then I always thought skew is a big deal. And then, and I look through you and Sinclair's stuff and what he said is that, people have spent billions of dollars and hours of research trying to figure out, how to make money on skew and things like that. But he said the vast majority of movement in volatility happens with the whole curve shifting up and down. Not skew will shift, and it does shift, but it's not really where your opportunity is. Like most of the opportunity happens when the entire curve shifts. So you're having volatility just in general kind of going up and down. And he's like, really, there's not as much opportunity in trading skew as you would think with all the literature out there on it. I don't really even, I occasionally, maybe I'll look and see if there's skew has altered a lot in terms of put buying and things like that. I think it makes a difference in the VIX, like the VIX skew makes a difference because of, I'm sorry, not the VIX skew. Well, the VIX skew also, but the SPX skew. So I think if you're looking at the S&P 500 or some other major index, then seeing like put skew change quite a bit might be a sign people are hedging and you have to start looking at the downside. But outside of like a couple situations which are sort of heavily monitored anyways, there's indexes out there that you can just look at and see a number. You don't have to really dig into it. But I don't really look at it anymore because it's just not that valuable. I mean, you have to probably follow skew pretty regularly in various instruments that you trade all the time to even notice that there's any real difference in it. So unless you're following it on a very regular basis and you can take some advantage of slight shifts in skew, I generally find that it's not worth spending a lot of time on.
Sure.
I talk about it a lot. I talk about it to my subscribers a lot, but mostly in terms of skew as it relates to the SPX and volatility and things like that.
Nice. So there you go, Will. Real, I'm assuming it's Real. He's asking, I set up a few trades over the weekend based on some of the site's guidance / numbers, which are based on Friday's close. When something like today's tweet tanks overnight futures, likely raising volatility for everything, should I cancel those trades and wait for tomorrow's open, at least 15 minutes into it, and then reset them? Good question.
That's a really good question, and unfortunately not something with a straight yes or no answer. I mean, if you are risk averse, and I generally am, I would probably cancel those trades.
Yeah, that's what the gut says for sure.
But I think that, I mean, sometimes these things are overdone and sometimes you miss out on an opportunity. So it's like, I don't think it's set in stone. I mean, sometimes the market's going to overreact and then get right back in, and then you won't have a chance to get back in at the level you want to get. So, I mean, it's not a straight yes or no answer. Personally, I would cancel them because I am risk averse.
Right.
And I generally don't even trade on the open like ever, unless I have to get out of something. I wait an hour or two before I make any trades because I'm not looking, unless I'm really trying to get out of something, expiration week or something like that, then I don't even look at the open for the most part. I might look at where things are, but it's too volatile basically. And you can get, screwed on your fills and
completely run over.
Generally speaking, the market calms down after the first hour and then you can get sort of better trades in at that point.
Yep. Good stuff. Mike, good man. Mike is asking, in your volatility forecasting for individual symbols, how important is the overall market volatility? Would you take a favorable looking trade in an individual instrument if the overall market volatility was unfavorable for the trade you are considering? So I'm not sure. Maybe you can give an example. I'm not exactly sure what he's talking about there. Can you give an example of that?
That's again, it's a really outstanding question. So,
well, these are the pros here, man. They were dealing with the top shelf.
These guys asked. I know.
Look at Jay sweating. Jay's like, "Oh my god, here we go! Challenges, getting it on." Here we.
I don't know why, but I feel like the air conditioning in this office went out at about 5 p.m. and it's about 100 degrees here, so it's. I don't think I have any way of turning on.
Dude, it's called. We have smart traders, man. They're asking smart questions, and Jay's on the hot seat.
That's a fantastic question. It really goes back to the correlation that I was talking about earlier. As the market goes down, right, assets tend to correlate, and I think that does apply to the volatility situation too. So yeah, I mean, if you see a major spike in the VIX and you're trying to sell volatility in a single stock or something like that, for instance, absolutely the overall market is probably going to trump that individual trade, at least for the short term.
Yep.
So it really depends on, if this is a longer term trade and it's just going to be some short term noise and you can ignore it or hedge against it temporarily or something like that. But if you're trying to set something up and you're like, all right, I really want to sell, volatility, maybe sell a put spread or maybe sell a strangle or whatever it might be, iron condor in Microsoft. But the market's, down because of a tweet by the president and volatility spiking and, that's definitely going to impact these stocks individually as well and impact the volatility. And it might actually give you a better chance to sell at later on. So
absolutely.
There are certainly situations where something is so extreme that it doesn't matter what the rest of the market is doing.
Yep.
This will be particularly true after earnings. So if you have volatility in a volatility level in a stock that's normally around 50 and it goes up to 100 ahead of earnings, and then earnings come out and whatever, it's extremely positive. Even if the market tanks that next day and the stock goes down, most likely that volatility is still going to go down quite a bit because of the event is over. So there are some situations where even if the stock goes down, that volatility might also be going down because it was at such a high level ahead of time.
Yep. Good answer, man. It's funny. Real is writing. He agreed with your commentary on maybe getting out of the stock or not doing that trade. He said, unfortunately, I have to set trades before I go in for my day job. Bro, you got to get another job.
Do it on your phone.
Can everybody, wait a minute, can everybody trade on their phones now? You don't need, come on, man. You can figure it out. Good stuff, man. All right. James is saying, I hear I should stay away from straddle strangles, credit spreads in a low IV environment like now. Should I really just focus on calendar spreads and debt spreads in an environment like this? I like credit spreads, but wondering if I'm getting into that at the wrong time.
Man, I need this every week because these are great questions and it really gets me. And next week I'm going to be at the Money Show in Las Vegas and the questions, they'll probably be, judging by the crowd, they'll be a little bit more basic and stuff like that. But this is really going to prepare me for that. Like nothing is going to seem challenging because I mean, this group is just asking fantastic questions, and I really you have to use all the cylinders of my So that, but again, all right. I mean, another fantastic question. So, it's all right. So, well, strangles, straddles, and credit spreads. I mean, so I don't ever sell strangles or straddles on their own. I mean, that would be either a, butterfly or iron condor. I mean, you never want to, unless you're a pro. I mean, you probably don't want to mess with selling straddles or strangles. Basically, and even selling butterflies is not something I mean, it's okay in cheaper stocks. I use them more for directional trades, but if you're going to sell, basically what you're talking about would be selling iron condors instead of selling strangles. Cause you you want to have your margin capped and all that stuff. Credit spreads are a little bit different because they have some directional exposure. I don't think that saying you don't want to sell these things in a low IV environment is correct. You will hear that a lot, but really, I mean, if you were to say I'm never going to sell a credit spread in a low volatility environment, you might go a year at a time without selling a credit spread, right? In 2017, we had no volatility the entire year, right? The VIX never got above 15 for the literally entire year, and I made a ton of money in my service selling iron condors because there was no volatility.
Yeah.
So, I mean, and then 2018 it was a lot harder. There was a lot more volatility, and it was hard to sell iron condors because volatility was all over the place. So, I think, you know, you still have to look at individual stocks and individual opportunities, and there's always like sort of micro opportunities amongst the greater scheme of things. And the thing is that as low as volatility gets, it can always go lower. So there's almost always opportunity to trade in a low volatility environment. That being said, you don't want to not look at debit spreads and things like that either. I mean, when volatility is low, you might be able to get some really good debit spreads or straight calls or puts or whatever in something that, you know, that you might think has the ability to actually move quite a bit, and you're going to get a much cheaper price. So, I mean, I don't think you don't want to ignore credit spreads. You don't want to ignore, you know, just long option trade either. Calendar spreads are really good in a low volatility environment. I'm a big fan of that. So that, that's something that you mentioned that you can always do in a low volatility environment. And that's kind of a, you know, sort of a no brainer for a low volatility environment.
Nice, man. Well, it's kind of like, you know, just, you don't necessarily ever take anything off of the table. You just, you know, figure out what works is what it is. You got to figure out what works. Gary's asking, do you use delta neutral strategies much? Short stock, long call? If so, when? And how often do you adjust them?
So I sort of do. Now, as a market maker, everything we did was delta neutral. The issue with delta neutral for me now is that most of my subscribers are, you know, either new to options or, you know, I mean, even if they're even if they're regular option traders, that they're still, you know, like things relatively straightforward. And the problem with going delta neutral is it involves a whole other, you know, I mean, first of all, it involves a lot more capital, right? So the stuff that I do with, you know, with credit spreads and things like that, you know, I keep my spreads pretty narrow. You don't need a lot of money to do them. If you start getting into delta neutral trades, then you need a bunch of money to trade stock or to trade futures or whatever it might be. And so there's an issue there. The other thing is that it's sticky in the sense that you basically need to be looking at, you got to be in front of your screen quite a bit if you want to stay delta neutral. So that's not really what most of my clientele is looking for. So ideally I would be trading. Ideally I would only be trading volatility and everything would be delta neutral, but it's just not practical dealing with, you know, the traders that I generally work with. It's just not a practical strategy. That said, I do sort of have a delta neutral portfolio in the sense that I beta weight everything to the SPY, and then I use SPY butterflies or put spreads in order to keep my delta as close to zero as I can. So it's not precisely delta neutral because everything is beta weighted towards SPY, but the portfolio, generally speaking, is neutral with the hedge. I try to get it, you know, pretty close to zero from a beta weighted delta standpoint. I don't know if that makes sense, but
wow, that's good stuff.
Basically relating it to how it would move along with the S&P 500 and then hedging in that sense.
Yep. Awesome stuff, dude. Olga's asking, Jay, what's your Twitter handle?
I think it's just my full name. It's just Jay Soloff. I got in early.
Man. I'm gonna look. You know, it's funny. I don't even know how. Maybe I didn't even know you were on Twitter. I'm punching it in right now. That's awesome. Mike's asking, Do you see volatility ETFs as a tradable instrument and not just hedges? The VIX corresponds to the SPY, is only minus 0.75, and even in high volatility conditions is only a minus 0.9 or less.
Yes, I do think I trade volatility ETFs all the time, not just for hedging. I think that they make wonderful instruments because despite the correlation or negative correlation with the index, they tend to move differently. So the correlation is taken over time as an average, and it doesn't really necessarily explain the day-to-day movement, and volatility moves very differently than stocks and indexes tend to move. And I feel like they are a lot more predictable. And for example, the dividend guy at Investors Alley and me, we have a overwriting service where we basically take turns picking stocks and then either doing cover calls on them or doing cash secured puts. And the one that I always have on is I have a covered call on VXX.
Right.
And it's been just a wonderful trade, right? Because you have a lot of juice in those calls because of the potential for volatility to spike. And as you keep doing it, you keep lowering your basis. So even though volatility tends to go down over time, by selling those calls, you're constantly getting a lower basis and kind of keeping track with it. And then anytime something spikes, you're golden. You own the shares. And so it's been a wonderful covered call trade that also sort of works as a hedge. So that's just an example. I mentioned earlier UVXY and VXX that you can use them for credit spreads. You have to be careful. You just don't want to do it willy-nilly, but targeted credit spreads and things like that. I love it for that. I love trading the volatility ETFs. I wish there were more of them that trade.
Can't get enough, man. Can't get enough. Mike's asking, he's saying Sinclair has 3 books on volatility. What was the name of the book you said? What was it called? He's saying they have 2018, 2010. It's probably 2013 you'd want, the most recent, right?
I think one is a second edition of Volatility Trading is the first one, and then there might be a newer edition of it. He's got another one called something like Options Trading and Volatility. It's a little bit more basic. He actually he will tell you he likes his second book better, but he says traders like his first book better.
Who cares what he likes? It's what we like.
Yeah, it's funny. Yeah. The option trading and volatility, the second one is definitely a lot. It's a lot more. He tries to approach a wider audience, where volatility trading is definitely more heavy math, and you have to read it a few times to really get his message. So I would say, option trading volatility is a good one to start with. He's got another book coming out. I think he just sent it to the publisher. It'll probably be another 6 months. But it's going to be about position trading and things like that, that our group, what I do and what everyone here does, is going to love. I mean, I can't wait for it to come out because the guy's a freaking genius. And so next year he'll have another one. There's not a title yet on it.
What's his Twitter handle? Do you know? By the way, I can't find yours. So apparently you don't even know your Twitter handle, brother.
Be one word at Jay Soloff, I believe.
Yeah. It's, no, man.
I can look that up. Ewan Sinclair also, I think it's just his name.
Let's everybody get on our Twitters, because this is very important, man. I have you spelled as, what are you?
I am at Jay Soloff, just the letter J.
Of course. See, man. Come on, brother.
Don't know my own. All right,
there we go.
See what you would.
And you got the Kansas City Royals image. That's your image?
That's me. I'm from Kansas City. I'm a huge Royals fan. So
all right, man, we're gonna get you some followers, including myself.
So Ewan Sinclair is Sinclair Ewan. So SINCL. Why don't I just type it?
There you go.
We have an entry box here. I couldn't see it on my screen the way I had it set up. Here we go. Where is my...
The thing I love about, I am not a huge Twitter fan, but for stocks and this sort of thing, I think it's a wonderful, wonderful tool. It can really be quite excellent. And I found you, Jay. You got a new, at least one new follower today, brother.
Nice.
There it is. We got it.
I mean, most of what I do, I mean, I follow all these fund managers and volatility traders, and I usually just respond to them. I don't do a whole lot of tweeting of my own. Every once in a while, I usually respond to people when they talk about something.
Sure.
But there's really, really smart people who trade volatility on Twitter who are really generous with what they share. You know,
it's really
I've learned
incredible.
a lot.
Yep.
Okay. All right.
Cool. So Mike's bringing us another question. He says, we've been taught that implied volatility decays immediately after the earnings announcement. But in our experience, how fast does IV really decay after those events?
Pretty quick. It really does. It really does. You know, there are situations sometimes if something comes out that's really bad news and it drops a lot and then it keeps dropping, you might have volatility sustained. But if you ever look at here, since we actually have the screen here. All right, someone
here. I'll make the screen big. We got you.
Someone just mention a random stock. I don't care what it is. Any
all right,
stock,
somebody first stock typed in, we'll pop it in there for you guys. Which stock, what's everybody gonna hit us with tonight? Number one stock, it's CGC. CGC.
All right. Sorry, my thing's moving a little slow for me right now.
Yeah, that's all right.
So while this is coming up here,
everybody loves the weed stocks.
All right. Do we have options on this thing?
You might not even have options. It's probably either maybe even new. All right. If there's nothing there, you can go. Next one's Mike with VXX.
Oh, sorry. I don't want to use VXX for this particular purpose just because there's no earnings with VXX. Here we go.
Okay.
Here's the chart. I got CG. Just my screen is
cool.
loading a little slow. I got CGC up here. So we do have options. All right. This one's not quite as easy to tell. Let's do something that has a little bit more traditional earnings, like I'll just do Microsoft. I've realized for what I'm trying to show, we probably need something that has a little bit more standard earnings cycle.
Sure.
But all right, so this is a little bit. Even so, I mean, we have all this noise from the end of 2018. But if you look at if you ignore all the volatility we had at the end of last year, and you look at most of these earnings cycles, you can see here two relatively normal earnings periods. This one was probably an earnings period here, where volatility drops almost back to normal almost immediately. It takes a day, right? That is what I would say is a normal situation for volatility after earnings. And I just had one. I have a long only service, just buying calls and puts, and that's really just to introduce people to options. Not a good way to make money, but a good way to learn options. And we had a call trade in AMD that was, like a 30. It was the stock. It was like, I think I got the 30 call when the stock was like at 29, but it went down to something like 27 before earnings came out. And then earnings came out, they beat, and it went up to like 29 something before selling off. And the option lost money, and people are writing in like, why is that? It's up to almost, our strike. Why is it lost money? I'm like, unfortunately it didn't go far enough for us because volatility came out. And, that's why it can be really difficult to buy options into earnings, because you really have to get the direction and magnitude of that direction a ton, because volatility drops almost to its normal level almost immediately. So I probably just could have said that, but it was kind of nice to show some of these situations where you can see after these earnings periods, not including this kind of crazy period where it went right down almost immediately.
Immediately dropped. Yeah, that's good stuff, man. Gary's asking, do you use a certain strategy to identify the best potential credit put spreads?
I use most of my research starts with Market Chameleon's credit put spread screener. It's a really good tool for that. I put in I put in sort of delta ranges I'm looking for, like let's say under 30 delta for my short strike. I look at things where earnings are not coming up. I look at the theoretical edge. I use I might then go in and tweak it to, I might find some different stuff in the Market Chameleon screener and then, pick my own strikes or whatever. But a lot of the time, most of my research, I use that, that Market Chameleon screener. It's a really good way to kind of see where you have some elevated volatility in the put skew, or I'm calling it put skew, but not as in trading skew on the put side of the ledger.
Right.
It's a very good tool for that. Very, very nice. I was really happy when Market Chameleon added that to the feature list because I use it all the time.
Yeah, man. Hey, that's what the Chameleon's for. Hey, Mike's following you now. So I followed you. Mike followed you. I think Olga followed. We got you a couple followers today, man. All right, man, you did all the questions. Oh, wait, hold on. Wayne got in the last question. All right. Wayne says, pretty basic question. If I put on a calendar put spread day before earnings, in general, I am more likely to profit if the underlying stock drops or rises. So am I more likely? Mm-hmm.
Yeah, I mean, it really depends on the magnitude. I mean, you're more likely to profit if it doesn't move that much in either direction. So the put or call aspect of it doesn't really matter unless you're closing out that short strike and then holding on to the back month. Really all you care about is it not moving all that much. So it doesn't really matter if you were to look at the P&L graph for a call versus put calendar, they would look almost, if you pick the same strike, they would look almost the exact same. You'd barely be able to notice much of a difference. The one thing that I'll say is that what I like to do is you can call them strangle swaps or double calendars or things like that. It's kind of nice to pick a range instead of, you might, if it's a more expensive stock, like it's like a Netflix or an Nvidia or something like that, you can pick out of the money calls and puts and sell those versus back month out of out of the money calls and puts. And that's an interesting way to do it, because then you may have less adjustments. Again, assuming it really depends on if you plan on closing the whole thing or if you just plan on closing those short strikes and then holding the long ones. And there's some different strategies you can do there. But I like to buy back month options and then sell those front month options against them, and then repeatedly sell them until I have those back month options on for very cheap, and then wait for a move. So you might do that 3 months in front of earnings.
Right.
So, so for a couple months you sell options against it, and then you have those options for, almost nothing come to earnings. And then if there's a big earnings move, you've made all that money, so that's just one strategy you can do with it that I like.
Dude, that's some great stuff, man. Jay, you brought it tonight, man. You earned it tonight. Jay was on the treadmill tonight, man. Awesome stuff, brother. Thanks so much, man. Oh, woo. All right, Wayne. Oh my God. Now everybody's kicking in. Oh yeah. Wayne saying thanks for the good answer, brother. Thanks for the answer. Thanks for Wayne chiming in. Hey man, everybody, thanks. I know everybody wants to get out and hit the Game of Thrones is happening in like 5 minutes. I promise to get people out of here by 8. So I'm gonna cut off the questions there. I know they're going on forever. Everybody now is chiming in.